The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome, everybody, to Volatility Views. And as you can tell right away, this is not your usual host, Mark Longo, but rather Don Schlesinger. Mark is over at the Money Show, and he might run back in time to join us by the end of our segment today. If not, we are ably represented by our regular pit reporter, Mark Sebastian, from the Option Pit.
Mark, hey, Don, how are you doing?
I'm great, and thank you for being with us. And we have a very special return guest today. We don't get too many repeat performances, but we have...
Don, do you think that's because of us or because of them? What do you think?
Yeah, I think we probably scare them away so that they never want to come back. But
that's my feeling.
Case, the brave soul who's no stranger to the Options Insider Radio Network, Mike Cavanaugh, president of Know Your Options, Inc. Mike, welcome back.
It's great to be back. It's the honor of being, am I the first return visitor?
I believe you are.
You're the first, but you're pretty close. We've only had one or two, so we're happy to have you. And as I was checking back over our archives, I saw that you actually did our show number 15, probably more than a year ago. And
gotcha.
Here we are 50 episodes later, taping our 61st Volatility Views, 65th rather, 65th Volatility Views. So,
so I'll sign out now. I'll see you at show 115. And
there you
just
go.
take it from there.
A little water under the bridge and a spot of volatility here or there, but in any event, it's great to have you back. And with that, we're going to proceed to our first traditional segment where we take a look back at the week in review, Volatility Review.
It's time for the Volatility Review.
And let's kick it off, as we often do, by taking a look at the S&P and perhaps some VIX activity and what Mark Sebastian has seen in the old VIX land and implied volatility over this past week. Mark, what observations do you have for us?
Well, here we are back at 14. We broke 16 briefly in the middle of the week, but I think one of the things is that, and stop me if you disagree, Don, I think volatility moves in cycles, long and short-term cycles. And we are leaving a long-term cycle of higher volatility. Caitlin Kiernan from the Wall Street Journal tweeted out that the average over the last 5 years has been about 22%. And I think we're entering a period of lower overall implied volatility, that's going to land somewhere between probably 16 and 18% and get the VIX's long-term average down toward 19. Because, we had a lot of this is probably one of the more important jobs reports that we've seen in a while. There were a lot of people that thought it might determine the election. It's not going to be the case, but and the VIX barely moved. The markets are just kind of creeping higher. Realized volatility's in the toilet. Looking at the overall VIX term structure, even that's gotten relatively flat. We've got the front month future with more than a couple of weeks to expire, trading about 15.30, pretty tight premium. And you have to go out to February before we see a VIX future that's above 20. Now, here's the crazy thing, Don. The May future is trading around 24%. That is 3 times current realized volatility. 3 times. And, close to double the cash VIX. It is incredible, some of the back term premiums that exist right now.
And you know what, Mark? It's very interesting that you bring this up because we didn't compare notes or discuss anything. But last night, as I was looking at some charts and trying to think of some of the things to discuss, I always turn my attention towards that contango that we talk about, at least with the VIX futures. And I looked at the realized volatility chart going back, let's say, a couple of years. And in this case, I was looking at the S&P, realized volatility, and I was looking at the 1 month, which would be the 21-day historical moving average, compared to the 3 month, which of course is this concept of going out farther. And as we've discussed many times on the show, there seems to be this absolute mania with the notion that, the farther out you go, the higher you have to trade the volatility, as if it's some sort of unwritten law that, gee, if you just wait a little while longer, volatility is surely going to be higher, And
it's ridiculous.
So you take a look at these charts, the point is you see absolutely, it's great when you look at the graph, the 3-month moving average continually and perpetually crossing the 1 month moving average, which is to say that there's just absolutely no particular trend or any particular reason why a person should be moved to believe that just because you're trading 3-month volatility, it's got to be higher than 1 month. And I counted on a 2-year graph, a 2-year chart, the 3 and 1 month historical averages crossed 12 different times. So an average of 6 times a year or every 2 months back and forth. If you go to somebody and you say, which should be higher, 3 month or 1 month, I wish just once somebody would say, well, you know what? That's not clear cut at all. And I'm really not too sure about that.
Yeah.
So that's a point that goes hand in hand with what you've just brought up. And of course, the other point that you're making, and I do agree 100%, is we were in a higher, both realized and implied volatility environment for so long that people just began to believe that that was the norm. And so now, when you're clearly in a lower volatility environment, and we have been for some time, they take a look at realized at single digits or 10, 11, or 12, and understandably VIX at levels of 13, 14, 15, and they say, oh, that's impossible. That's too low. There's too much complacency. We're going to have a pop, et cetera, et cetera. They can't wrap their heads around the fact that we could stay at these levels for a very long time.
Yeah, and in the long term, I think, Don, you could make a case that with the VIX at 14, May should be trading 19 or 20, more toward the long-term mean. What is fascinating to me is that they would trade it at a full 20% premium to the long-term mean. I have trouble fathoming that. We're gonna really May should be trading 24. If you told me 19 or 20 with the VIX at 14, I would actually say that was maybe make some sense, wouldn't you?
Yes, I would have to agree, and we've often spoken on the show just for historical references. Anytime you look backwards doesn't guarantee anything for the future. Everybody knows that. But if you want to go back, 100 years, the long-term historical actual or realized volatility of the S&P is in the 15 to 16% range. And we've spoken time and time again about implied volatility and the risk premium to realized. also having a long-term average of about 3 to 4 percentage points higher than realized volatility. So it makes your point exactly that historical norms would place VIX and implied volatilities in that 20% range or so. So when you're at levels now that are 13, 14, and 15, despite what I said a moment ago, it isn't at all unreasonable if you're looking farther out to play that card of reversion to the mean and saying, look, if you put a gun to my head, I think vol will be higher in 6 months than rather than lower. But again, your point being well taken, why add 8 or 9 or 10 points to the current levels rather than just those that would bring us back to the historical means?
Very good points by all. I've always said that the million-day moving average in the VIX was 15.5. When you go above it, it seems like you flash above it. I think in '08, what the VIX got up to 89. It didn't stay in the 80s very long, and then the whole downward move, 70, 60, 50, 40, 30. We hung out in the 20s, split back up to 40. I think we're in a mid-range volatility, but everybody says, "Oh, it's so low, it's so low." The problem with the VIX and volatility and the timing of it is, if you're bearish on vol after a vol spike and you sell it too soon, you can get hurt really bad. You got to time it perfectly, and it's something that you don't ever talk to people like, "Hey, I think we should short the VIX here," because if the VIX gets worse, it gets worse really fast. And it gets really bad really quick. If you're lucky enough to time it quickly on an event, if you're selling the vol, it flashes in quick, and I think that's what's attractive about it. On the flip side of it, if you remember back from '02 to probably about February of '07, so a good 5-year stretch, for a year of that stretch, the VIX was under 10 or right at 10. I think it was around 9.
I remember.
Well, that was that. Yeah, I'm sorry, Mike. That was that historical period, which was the raging bull market, and obviously when the market was rising, you had that inverse correlation with VIX that brought you down to single digits of realized volatility and this extremely low reading for the implied.
Right, and I remember, and I think it falls right in line. I'm totally in full agreement with you that a contango right now in the February VIX trading at 24, it doesn't make sense, because when you look at the inverse, a flash higher on the VIX, it usually comes back in fairly quickly. Who knows how long vol can stay down? I mean, you look at QE1, QE2, QE3. Obviously, we're settling in, and we all is well, and we should relax and sit back on the front porch and drink some lemonade and sip it and read the Wall Street Journal because all is well. The timing, when is the vol spike going to happen? It could happen 6 years from now. It could happen in 6 weeks, but it always seems to cost more and take longer when you're trying to time a spike in vol.
Well, that's the fun part of it, and I think both Mark, Sebastian, and Longo and I have been mentioning this now for some time as people keep looking at this low vol environment and saying, gee, this can't last. And we kind of keep on saying, yes, it can. And at least for the time being, we're proven right. And we realize that nothing lasts forever. And there's going to come a time where we are going to have the spike and it's going to go higher. And then those closet doomsayers are going to come out and say, see, I told you. But meanwhile, they're going to have been choking on buying the volatility for a year or so. And, that's always the case. So when vol spikes, don't come running and say, I told you so, because where have you been for the last 6 months or so? Anyway.
Right. Well, now it's been, 8-9 months. And it's exactly right. The doom and gloomer who's out there saying, oh, it's coming, it's coming. The Mayans were right. The world, the end is near. I kind of look at it as the same kind of correlation that we see in the interest rates now, where everybody's like, interest rates can't stay this low. They're going to spike. Everybody, if you got a mortgage that has an arm, you got to cover this thing. You can't be long bonds. This is insane. But you look at it and you're like, they're not going to raise interest rates anytime soon. It could stay. It could go 6, 7, 8, 9, 10 years out. So the paradigm shift here with the VIX is we're at 14, and like you mentioned, on the 100-year moving average on the VIX is about 15 and a half, in between 15 and 16. So we're kind of at moderate levels, and you might see a spike here and a spike there, but it's very interesting that you see people able to time up spikes in the VIX. It costs a lot of money, and it always takes longer than you think.
Well, that's certainly true. And just before we close out the current review segment, I usually run by the realized volatility portion, talk a little bit about both NASDAQ Vol and the S&P, but I'll be very brief. Very, very little happened since our last particular broadcast, which was about a week ago. And the past week has been extremely calm in terms of volatility. We had predicted the possibility of a slight rise, but as a matter of fact, there was the ever slightest decline. We're talking about hundredths of a decimal point. So we're at a point now where volatility in both NASDAQ and the S&P is about the same as it was a week ago. We're looking at 11.5 realized for the S&P, which again is very low, and about 13.8 for NASDAQ. So those are levels that were just about unchanged from our last broadcast a week ago. And as we've been saying, that doesn't mean that we should expect great leaps in realized volatility either over the weeks to come. We'll talk a little bit more about that in our crystal ball segment as we try to look into the future a little bit later on. But that's going to do it for our volatility review segment. And now we proceed to volatility viewpoints.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And as you know, on the Volatility Viewpoint segment, this is when we start kicking around some ideas and try to talk about the wonderful and wacky world of volatility. And every now and again, we're privileged to have a guest and somebody to come on the show so that the two Marks and I can shut up a little bit and listen to the wisdom of some of our guests. And as we mentioned a little bit earlier, we're happy to have back as a repeat guest Mike Cavanaugh, the president of Know Your Options, Inc. Mike, formally, once again, welcome back to Volatility Views.
Thank you very much, Don. It's great to be back. And as mentioned earlier, it's great to be, I guess, the cameo appearance for every 50th show, it appears.
I love it.
We'll have to book you into the future for number 115, as you said earlier.
There you go.
And Mike, although you are no stranger to the Options Insider Radio Network, we are constantly bringing on new listeners to the show who may not be familiar with you or your background. So before we get into some of our meaty discussions, why don't you take a couple of minutes to tell us a little bit about you and Know Your Options and what you do on over there?
Yeah, absolutely. I'll give you a little bit of a bio background as well. So I've been in the financial markets for the last 16 years. I came right out of college and went to the what I like to call the pits and bowels of capitalism, and I was on the exchange floor at the Chicago Board of Trade. So I am no stranger to volatility. I started trading in Nor
are you a stranger to bowels.
I knew something was coming. No, but I started trading back in 98 in the summer, right before the long-term capital mishap in the summer of 98. So you had all those changes in the interest rate. So it was an interesting volatility time. So after I left the floor, I ended up going to a startup firm that was in the futures realm, and left there in about 06 and started Know Your Options. And we're basically a full-service advisory firm. We're a registered investment advisor in the state of Illinois, and we work with clients both in a discretionary and non-discretionary capacity, where we help people either tailor a portfolio, hedge individual stocks, come up with strategies that have options either overlay or underlying, and it's going, it's going great. We're just at about $20 million in assets, and we're always looking to meet new people. And we also have an institutional execution desk run by Brian Sweetman. He sits right to my left. So we deal a lot in the option space, and that's a little bit about me.
That's great to hear, Mike. And as always, I think our viewers are interested in what the public is doing with products that are not only volatility based, but perhaps options based as well, which is your bread and butter. So with that background in mind, why don't you give us a little hint of some of the things that you may be doing that are interesting to hear, perhaps in volatility terms, with respect to the past year since you've been on the show. Perhaps we can talk a little bit about the public's appetite for some of the new volatility products, and perhaps even go into some of the products that we will be offering on the Volatility Exchange in the near future.
Yeah, I mean, where we see the most questions come in from our client base, or even from the retail public in general, is how do I hedge a stock portfolio, or how do I hedge an option trade with a volatility product? And it's difficult for a lot of people to have that conversation, because you can explain, here's how you can do it, and they're like, I don't get it. So we've always tended to hedge apples with apples. And speaking of apples, Apple is the stock that most people are looking to hedge. So I think with your volatility exchange, I think there is an actual Apple volatility product. Am I right on that?
Well, that happens to be a VIX or an implied product. But of course, when we come out with our realized volatility, we are going to have vol contracts on the NASDAQ, where Apple is, of course, an extremely important component. And although it may be a little bit down the line, we do envision the day when we will have single name realized volatility products as well. And in that particular time, it isn't too much of a stretch to think that the demand for a realized volatility product on a name such as Apple might be at the very top of the list.
Yeah, I think you're smart for doing that, because that's what everybody's holding. That's what everybody has questions on. The other trend or activity you see is that the yields are so low right now. So when you look at people that invest, I'm not talking about the traders, I'm talking about just the pure investors. And I've always looked at it as the stock market is a vehicle that was created to hedge risk. Most people kind of scratch their head when I say that, and they say, well, no, it's a vehicle that you're supposed to invest in to make money. And when you look at it, the money that you're investing, it goes to help save for some sort of event, whether it's retirement, college savings, whatever it is. So your risk is you're not going to have enough money when you retire, and you invest in the stock market to hedge that risk. So when we look at risk and volatility, the people that are investing money for the long term, that have to invest in things that are deemed as safe, AAA bonds, whatever it is, the yield's not there. And for the first time in my career, you're getting demand from these larger institutions, larger pensions, that are begging to get an education on how to get yield to protect risk. And options offer an unbelievable advantage over just a stock portfolio or a long short equity portfolio, that you can actually look at a core plus bond fund for a pension and say, hey, you have the ability to actually use options and do a collar strategy where you pay attention to volatility or not. Here you have the potential to actually get a little yield while you're still protected. So there's definitely been some demand coming in from an option standpoint with a collar strategy as well.
And I think we've asked this question of other people who have been running money and who deal with the public and retail. Volatility is still, although it's been popularized and we have so many products on the market now with more coming out, volatility is still perhaps not quite Main Street for every retail investor, especially self-directed ones, to be able to get a good grasp and to be able to have an understanding that will allow the public to do these kind of trades that we categorized as volatility trades. In your experience, as to your general clientele, give us some sort of a feeling for the public's appetite these days as volatility becomes more important, maybe percentage-wise, or just in terms of the level of sophistication of the client. Are they ramping up the curve a little bit, and are we seeing more interest in the whole idea of doing these kinds of trades that actually hinge on volatility, which is the case for almost all options type strategies?
Yeah, no, it's a great question, and it's not a question that's easily answered. So I'll take my best stab at it. I think you see the demand in it, and you see the demand. It was kind of born after 2008. The Chicago Board of the CBOE did a study, a volatility study, saying if you bought X amount of out of the money calls on a volatility product, that you could have hedged your entire portfolio. And they put a lot of money into that. And like you guys create this exchange, and now we've got volatility. Is it an asset class? I think there's been a lot of buzz around volatility. I still feel that there's a demand. We're getting calls on it. But the simplification of it, when you look at what Apple did, I keep beating up on Apple, but when you look at what Steve Jobs did at Apple, he took a very complex idea of, I want somebody to be able to spin a wheel on a little handheld device, and within 3 spins, they can hear their favorite song. So he made something very complex, very simple. And I think that's yet to be done in the volatility product world. I think as soon as you have somebody that takes a very complex, it's a derivative of a derivative. You're trading volatility is basically the vol of the vol. I think when somebody's able to simplify that and make it very easy for the retail investor to understand, if you do this, here's what the expected outcome should be, and this is why you would do it. I think once you have like that 3-step simplification where a retail client can fully understand it, I think you'll see a boom in it. I think most of the demand that where the actual trading comes in are the hedge fund guys or the algo guys that have got a very firm grasp on this, and they're probably making some money in it, and they don't want to share it with the retail public. So once it becomes more simplified for the retail public to understand, I think you'll see a move towards the retail people being able to trade it. And then who knows, by that time maybe there's a new product that it's too late to make any sense out of all, and there's something else out there like the third derivation of volatility.
Well, that's a very interesting point, Mike. And as a matter of fact, this is something that we are striving for at the Volatility Exchange. The motto is, keep it simple. And we hope to be able to explain how vol contract futures will settle simply to the movement, regardless of direction, of some underlying, like the NASDAQ 100 or the S&P 500, and not have to get into some of the complex explanations, VIX-like proportions, so that the public can embrace the idea of trading simply the movement, whether it be up or down, of the underlying. So actually that was a question that I was going to ask you perhaps a little bit farther down the line, but why don't we take a look at it right now in terms of your own portfolio management and, of course, the ability to introduce such a product to the public. Do you think that perhaps for those people who in the past may have traded options straddles as a way to try to capture volatility, that a product that simply settles to the realized volatility of an underlying, be it an index or down the line a single stock name, may be something that the public and even portfolio managers could come to embrace?
I think so. I think yes. With how you see the larger institutions hedging portfolios, I still think the majority of the people are using the S&P options, the SPX specifically. Yep. And I think they're waiting for somebody to come out with a way to say, hey, this way is a little bit better, guys. We should go over here. And I've never understood this, and I think they're still doing it the same way. Mark, correct me if I'm wrong, but that whole special opening quotation on the S&P has, for the last 16 years, not only befuddled the public. It befuddles me to this day. I know it's a weighted staggered open. I've talked to S&P several times about, why do you guys do it this way? Why don't you just use the number where the market opens? It makes no sense. It's baffling.
Well, I guess the only reason that you would do it that way is if somebody was hedging using the opening print and did a market on buy or market on open buy, market on open sell. You'd end up with the same price.
Right. It's still like
that's the old, but I don't know if that makes sense or not. And intuitively it does not, but it intuitively absolutely allows for price manipulation.
Right. I mean, you don't want to say it. You want to say, oh, the market's efficient, but in the back of your head, you're like, well,
and the VIX opening rotation is not manipulated at all.
Right. So looking at, hey, here's what it is. It's transparent. Here's where the market closed, and here's how this product settles in a transparent manner. I think as soon as you find a system or a professional that says, hey, guys, here's a new benchmark, here's how we use it, and you get some institutional size in the product, that's always the catch-22. The exchanges are always trying to roll out new products. I've had clients that have been market makers in new products, from the CME to the CBOT, and the sticking point of any new product is always, can we get institutional money to actually use this as a product? And if the answer becomes yes, then you've got something. And I think the simplification and transparency definitely plays a part in that. No matter what anybody thinks about the stock market, U.S. capital markets in general, I argue that there is definitely a fundamental need, and there will always be a fundamental need for the market. And those people that have the fundamental need are those large investments, institutions, or a family that is looking to hedge their retirement risk or whatever they're saving their money for. They have a fundamental need to hedge the risk of investing in the market. And if you have a product that is transparent and easily understood, and institutional money goes into it, the people that have that fundamental need will use the product.
Well, we actually have commissioned a study that I've alluded to for the past couple of weeks, and we're going to have the author on with us probably about 2 weeks from now. And the purpose was to try to take a look at various overlays of using equity volatility contracts in conjunction with a stock portfolio to see what kinds of strategies might be possible to either enhance returns, lower risk, or in some cases, perhaps with an active allocation, actually arrive at doing both at the same time, which is always very attractive. And we have some very interesting findings and just putting the finishing touches on all of this. So listeners, stay tuned, and in a couple of weeks, I think we'll have an interesting topic to discuss with you. Mark, do you have any questions for Mike? Anything that we could further elucidate in the wonderful world of Know Your Options?
Yeah, that's I got a couple of questions, Mike. I know that you do a lot with collaring, and can you talk to us a little bit about and Mike too saw one of your cohorts, and I kind of talked about this. Can you talk to our readers about the diagonal collar that you guys have been instituting and why you guys like it so much? Because I think that it's an approach that a lot of traders could use.
Yeah, definitely. I mean, I can't take full credit for it. The Options Industry Council released a paper on this in the spring of 2009 called "Collaring the Cube," and the strategy basically said there was an active strategy and a passive strategy, and it did a price correlation between doing a front month collar on what the cost of the put is and how much time decay there was in the call versus buying a long dated put option and selling the front month call. And what they found was that you don't have to try to time the market or price the volatility in. Looking from a pure time decay aspect, the time decay on the long dated put is slower than the front month call. So basically what your job becomes in managing that diagonal time collar is trying to not cap your upside, and you have to hedge the call. You either do call spreads, calendars, or you roll the call at a certain point because you want to capture as much upside as possible. The thought is if you buy a put that's dated 13 months away and you're able to sell 13 months of the calls, you'll end up making more money on the calls than what you paid for the put, because the time decay is more rapid in the front month. So that's the concept behind it. And, you can use it on an index, you can use it on an individual issue, but that kind of gives you a long volatility with the put, and you're financing that long volatility by selling the front month call. And basically how you're managing this strategy is, if your deltas or thetas get out of whack, you have to roll up the puts and roll up the calls. And as an investor, you want to hold the underlying and collect the dividends, and it smooths out the volatility. This has been an ideal market for it because you've had a slow grind higher. You're able to capture some of the upside while you're hedged to a rapid move. So if the contango in the February futures, the VIX futures, is right, you don't have sleep at night risk. You're able to sleep at night knowing you have a basement, a floor, so to speak, on the underlying that you own by owning the put.
And I've often been a fan of this type of a concept, because obviously when you are trading volatility, it's often contradictory sometimes with calendar spreads, because owning the farther month and being short the near term, you mentioned that the Vega is positive. You profit from volatility, but by the same token, if you have a traditional, say, at-the-money calendar spread, you really don't want wild movement in the underlying. You want sort of an increase in volatility, but you don't want a dislocation of the market. So it's almost kind of like you're rooting against yourself. But when you do take this approach that you're mentioning, and you have the ability to ratchet up or down your strike prices and constantly be readjusting, and you get to sell that short-term time premium over and over again against the longer dated option, it can have some very favorable results.
Absolutely. And when we had this particular strategy on during the flash crash, and what we saw was a very, very small uptick, but it was still an uptick in the overall portfolio. I think the market closed down on the flash crash day, but the volatility spiked so much in the puts that the underlying was down, but the put vol had spiked so much that the portfolio was actually up about 0.1% on that day. So
that's terrific. That's a great result.
What you don't want, the nightmare is a fast move higher. That's where, you don't see the value. And that's why you got to look at this position as, the diagonal collar that we run is a long-term investment. It's not a trading strategy. It's a long-term investment. It's not active. The once a month call roll is about all you have, unless you get a fast spike higher and you have to adjust the put and the call at the same time.
Mike, are there empirical studies or data going back, obviously, how you implement this and what the rules are for follow-ups and adjustment can make it somewhat subjective, but I'm curious because the strategy does interest me for a couple of reasons, and I'm curious as to whether or not you might have done studies of your own, or Option Industry Council, or point our listeners and me as well as to where there might be some empirical data as to long-term results for this kind of an approach.
Yeah, we've done our own proprietary research, and we found it to be in line with the initial white paper that we read at the OIC. If you Google OIC collaring the cube, I believe the name of the professor that wrote the white paper on this, his name was Robert Zauda, I believe is how you pronounce it. He's at the University of Massachusetts. He did some, theoretical backtesting on the strategy, I think from March of 1998 to March of 2008. And basically what you see is a smoothed out return. It performed better with lower volatility. So like when you walk into a financial advisor's office and they say, hey, this is a long-term investment, we're going to put your money in this asset allocation model, and in 25 years, if you put in X, you'll get X amount back in 25 years. What they don't tell you is, hey, you got to hold on tight when volatility gets rocky. This strategy has a tendency to keep the volatility in the portfolio a lot smoother, so you don't feel the bumps on the ride.
Very good. I'm going to take a look at that. Sounds very interesting to me. Mark, you mentioned you might have had two questions for Mike. So before we let him go and close out this segment, was there a follow-up that you had?
You know what? There was, but he was so thorough that I don't need a follow-up.
Okay, fair enough. Well, then instead, Mike, I'm going to flip the final word to you. We always allow our guests to shamelessly plug anything that they may have going on at their particular place of business. So as we thank you in advance for your participation today, is there anything that you'd like to tell us about Know Your Options, Inc. that's either going on now, going to be going on in the future that our listeners should know about?
Yeah, I mean, my only shameless plug is to all the people out there that, want to either add some sort of yield to their portfolio or smooth out the volatility in their portfolio. That's what we do. We use options as an overlay to an equity or a bond portfolio to help smooth out the volatility. So whether it's a highly concentrated stock position that you want to hedge, or you're looking to, add some sort of tailored mechanism to your portfolio that either hedges the risk or adds the potential of additional income, we spend a lot of time tailoring portfolios to do just that. So that is my shameless plug. And where we're getting a lot of people and a lot of questions is definitely in the Apple arena. People saying, hey, I have Apple stock, and it's really been great, but I know that trees don't grow to the sky, and I'm looking at hedging this at some point. So we're more than happy to have those conversations with anybody that's looking to hedge a position.
Sounds great. And listeners, the website is Know Your Options Inc. Add that INC.com. There is a Know Your Options. I think it's a mortgage-based website.
Fannie Mae, yeah.
Yeah, don't confuse the two. You want Know Your Options Inc.com, and I'm sure that Mike would be happy to chat with you. You can also check out their 18-minute portfolio review, see if you're headed in the right direction. So once again, Mike, thank you very much for coming back, and we'll extend that invitation to you, and we won't wait 50 more episodes. You'll always be welcome here on Volatility Views. And that's going to do it for the Volatility Viewpoint section. And now we're going to head to our crystal ball.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment of Volatility Views. This is where Mark and I try to prognosticate and see what's going to be happening in the near future and perhaps the not so near in terms of implied and realized volatility, S&P, NASDAQ, and anything else that's out there. So, Mark, give us your best shot at what's coming up in the future for VIX and S&P volatility.
Don, if I had to take VIX up, VIX down in the next week, I'm leaning, we're now right up against kind of the highest levels we've seen in the market in some time. Intraday, we had the highest Dow level since 2007. We got the highest S&P level. Since, whatever. And now we're kind of we're selling off a touch. If we don't break, I'm not sure we're going to be able to hold this 1470 level. I think we might head back toward that 1450 level, and we might see that VIX kind of pop near 15. So I'm expecting little realized volatility, maybe a slight uptick in implied. The one area actually, Don, and I wish we'd gotten to this, is FX vol, USDFX, implied volatility in November, which is, we've got these Spanish elections coming up.
Right.
Their implied volatility in the options in November is around below 8.5. I think that's too low, and I don't think that's going to hold, even with realized volatility where it is. I just don't see how it's not going to tick up in FX.
And it sounds low because when you have an event such as that, and there is always that kind of uncertainty, usually before these kind of event-specific driven markets, you see a ramp up, surely in implied volatilities. But the number that you mentioned certainly can't be considered high or ramped up by any stretch of the imagination. So that might be an interesting play there.
Yeah, absolutely.
Well, thanks very much for that. And before we conclude, I'll just take a stab at some of the realized volatility indices and say what I've been saying all along, and that is despite the fact that we're at very low levels and despite longer-term forecasts for a potential reversion to the mean and higher volatilities, I just don't see a heck of a lot on the horizon right now that's going to get volatility going anywhere meaningful, especially in the short term. So despite these 11.5 and 13.8 levels that we're seeing for S&P and NASDAQ respectively, I doubt very much that at least in the week to come, we see any kind of significant movement there. So we'll kind of sit out on a limb and say don't expect a heck of a lot to happen in the next week or so, and of course we'll check back at that time. And that's going to do it for our Crystal Ball segment and also for this episode of Volatility Views. But before we go, we always like to give a chance to our co-host, Mark Sebastian, to let us know what's going on over at the old Options Pit and any seminars or webinars or anything else that he's got going. So, Mark, what's interesting for us in the coming weeks?
We had non-farms. I think these debates are going to be kind of interesting to watch. And I think that the Spanish elections on the 21st, the regional elections, I think those will be interesting.
And how about at Option Pit in general? Anything that you'll be doing in terms of...
I'm doing a couple of webinars next week. I'm doing one couple of things. And I'm going to be on Fox Business on Monday afternoon and Bloomberg on Tuesday, as well as I'm sure I'll pop up another couple areas. So look for me after right at the close of the bell on Monday on Fox Business.
Oh, that's terrific. I'm going to mark my calendar. It's always fun to see you, and our listeners who are accustomed to hearing your voice can see your beautiful face as well.
I'm sure that's such a good idea, Don. Do we want to know what I look like?
Well, thanks again, Mark, and that is going to do it for this episode of Volatility Views, and Mark Longo, our host, will be back again with us next week. My name is Don Schlesinger. Thank you very much for joining us and for tuning in and making the show the success that it has been, and we will see you next week on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.